There are 58.3 million ounces of registered silver sitting in COMEX-approved warehouses right now, and there are 634 million ounces of open interest outstanding against that same inventory. That is a 9.2% coverage ratio. For every 100 ounces that traders, institutions, and industrial end users believe they have a contractual claim to, only 9.2 ounces of physical metal actually exist in the registered delivery layer of the exchange. We are 12 days away from the June 2026 contract cycle opening on May 28th. If you have never watched this channel before, stay with me for the next few minutes because I am going to show you the exact signals that historically precede a structural break in the paper-to-physical bridge, and I am going to show you where each of those signals sits right now against the data that the COMEX publishes every single trading day. I have spent years tracking these warehouse reports, and while others focus on the noise of price action, I focus on the plumbing. Right now, the pipes are showing measurable stress. This is not about speculative theories or price predictions designed to generate clicks. This is about the cold, hard reality of a ledger that no longer balances at the margin. My methodology has always been straightforward. Follow the physical metal because paper can be printed, but silver must be mined. And what the physical inventory data is telling us in May 2026 is something we have not seen at this channel in its entire operating history. Let me build the foundation before we get to the signals, because the single most misunderstood concept in COMEX silver analysis is the difference between eligible and registered inventory. And that distinction is the entire structural story here. Eligible silver is metal that meets COMEX quality and assay standards and is sitting in an approved warehouse. It is eligible to become deliverable, but it is not yet earmarked for delivery. Think of it as metal that is parked in a compliant facility but whose owner has not yet decided to make it available against a futures contract. The owner might be a mining company hedging forward production, an industrial manufacturer maintaining a strategic buffer, a refiner holding processed metal between buyers, or a financial institution using the metal as collateral in a financing arrangement. Eligible metal belongs to someone with a specific non-delivery purpose. It is not on the exchange's delivery menu. Registered silver is the layer that matters for delivery mechanics. When a holder of eligible silver decides to make that metal available for delivery against a futures contract, they issue a warrant and the metal moves from the eligible column to the registered column. Registered silver is the pool from which actual physical delivery is drawn when a futures contract holder stands for delivery instead of rolling or cash settling. The 58.3 million ounces of registered silver that COMEX is reporting right now is the actual deliverable pool. That is the number that must be compared against open interest to understand the real leverage ratio operating inside the exchange. Total COMEX silver inventory, combining both eligible and registered, is materially larger than 58.3 million ounces. But total inventory is not the relevant denominator for delivery stress analysis. Registered inventory is. When we put 58.3 million registered ounces against 634 million ounces of open interest, the 9.2% ratio we get is not a theoretical construct. It is a direct mathematical statement about what percentage of outstanding contractual claims could be honored with physical delivery if claim holders simultaneously demanded it. Every large-scale commodities exchange in the world operates with some degree of fractional coverage because the overwhelming majority of futures contracts are never intended for physical delivery. They are rolled, offset, or cash settled. The exchange model is built on the statistical regularity of that behavior. The systemic risk question is not whether fractional coverage exists. It is whether the coverage ratio has fallen to a level where a statistically plausible shift in delivery behavior creates a mechanics problem that the exchange cannot resolve within normal operating parameters. In this channel's history, we have called out structural fragilities in the COMEX silver system before. The 9.2% coverage ratio is a level we have not previously seen, accompanied by the combination of factors that are present in the market right now. To understand why that combination matters, we need to walk through the 5 signals I track on a daily basis, where each of them sits today, and what the historical threshold for concern looks like on each one. The first signal is the registered inventory level itself, measured in absolute ounces and tracked against the directional trend. The current reading of 58.3 million registered ounces did not arrive overnight. This number has been on a sustained downward trajectory that reflects a structural shift in how physical silver is being held and claimed. In January of this year, registered inventory was measurably higher. The consistent directional move lower reflects a combination of factors that are all pulling in the same direction simultaneously. Industrial users who historically left silver in eligible status and converted to registered only when needed are now converting to registered and taking delivery more aggressively. Sovereign and institutional buyers who have entered the physical silver accumulation trade, a trend that has been well documented in the post-2021 structural deficit environment, are withdrawing metal from exchange warehouses rather than leaving it in the eligible pool as a tradable financial instrument. And the London Bullion Market Association squeeze of October 2025, which pushed the one-month silver lease rate from 1% to over 30% in a matter of weeks, created a generational memory event for large holders. When you have watched the free float in London vaults collapse to 17% of total inventory in real time, you behave differently about where you park your physical silver and whether you leave it available to the paper market. The threshold I watch on this first signal is 50 million registered ounces. Below that level, the mathematical buffer between outstanding claims and available metal becomes thin enough that a modest increase in delivery demand, not a dramatic or historically unprecedented increase, just a modest one, creates a situation where the exchange must take active management steps to prevent a disorderly delivery process. We are currently 8.3 million ounces above that threshold. That is not a comfortable margin at current delivery rates. The second signal is what I call sticky open interest behavior in the front month contract in the days leading up to first notice day. Under normal market conditions, open interest in the front month contract declines significantly in the 2 to 3 weeks before first notice day, as traders who have no intention of taking or making delivery roll their positions forward to the next active contract month. The rate of that roll down is one of the most informative signals available about the intentions of the contract holder population. When open interest remains elevated or declines more slowly than the historical baseline, it indicates that an above-average proportion of front-month holders are either intending to stand for delivery or have not yet decided to roll. Both scenarios create delivery pressure. The June 2026 contract, which opens its delivery cycle on May 28th, is showing open interest behavior that warrants close attention in the current inventory context. The absolute level of open interest against the registered inventory pool means that even a moderate percentage of holders standing for delivery would represent a significant demand on a registered pool that is already at a notable low. The third signal is the behavior of the spread between spot silver prices and the nearest futures contract, specifically whether that spread moves into backwardation. Under normal contango conditions, futures prices are higher than spot prices by an amount that reflects storage costs, financing costs, and convenience yield. When the spread inverts and the spot price trades at a premium to the futures price, the market is in backwardation, and that inversion is a direct price signal that the market is placing a premium on physical metal available for immediate delivery relative to paper claims on future delivery. The current spot to futures spread is showing approximately 75 cents of backwardation as of the most recent trading session data available for May 13th. That is not an extreme reading in absolute terms, but the directional movement and the context in which it is occurring matter more than the absolute level. Backwardation that develops against a backdrop of declining registered inventory, rising delivery rates, and an elevated open interest to registered ratio is qualitatively different from backwardation that occurs in isolation. The three signals are speaking in the same direction simultaneously. When backwardation in silver has historically widened to levels above $1 in the nearby contract, it has consistently coincided with periods of elevated physical delivery stress on the exchange. The fourth signal is the delivery notice count itself. COMEX publishes daily delivery notices during active delivery periods, and the running total of delivery notices for any given contract month tells you in real time what proportion of open interest is converting to physical claims rather than rolling or settling. Delivery rates have climbed from approximately 3.8% in January of this year to approximately 8.3% as of the most recent completed delivery cycle in May. That is more than a doubling of the delivery rate in 4 months. To understand why that trajectory matters, consider the arithmetic against the current registered pool. A 3.8% delivery rate against the January open interest level produced a certain absolute ounce demand on the registered pool. An 8.3% delivery rate against the June contract's open interest level, even if the absolute open interest were identical, would represent a dramatically larger draw on a registered pool that has declined since January. The combination of rising delivery rate percentage and declining registered inventory is a compounding stress function, not a linear one. The fifth signal is the one that market participants pay the least attention to until it is the only thing anyone is talking about: exchange rule changes and policy adjustments that alter delivery mechanics, position limits, margin requirements, or cash settlement provisions. Exchanges have a full toolkit of administrative levers available to manage delivery stress situations, and they use them. Margin hikes make it more expensive to hold large long positions into delivery, which mechanically reduces the population of holders who can afford to stand for delivery. Position limit adjustments can cap the size of any single entity's deliverable claim. Rule changes that expand the definition of acceptable delivery bars or approved vault locations can temporarily increase the effective supply side of the delivery equation. And in extreme circumstances, exchanges have the authority to impose cash settlement on contracts that would otherwise require physical delivery. The activation of any of these tools is itself a market signal, because exchanges do not deploy administrative intervention into normally functioning markets. The appearance of emergency or expedited rule changes is a direct institutional acknowledgement that the normal operating parameters of the market are under stress. As of May 13th, no emergency COMEX rule changes have been announced. I include this signal not because it has triggered, but because it is the signal that most definitively marks the transition from stress to crisis, and the analytical framework requires you to know in advance what you are looking for. Now let me give you the reality checks, because intellectual honesty demands it, and because credibility in this analysis space requires acknowledging the full picture rather than presenting only the data that supports a single narrative conclusion. The exchange is not a passive actor in delivery stress situations. It has tools and it uses them. The eligible inventory pool, while not directly deliverable in its current status, represents a conversion option. If registered inventory declines to levels that create genuine delivery pressure, owners of eligible silver have a financial incentive to convert that metal to registered status and supply it to the market. The eligible pool, which is larger than the registered pool, functions as a reserve capacity buffer. The conversion process takes time and requires the owner's active decision to participate, but it is a real mechanism that has historically operated to relieve registered inventory pressure before systemic breakpoints are reached. Cash settlement is another real mechanism. The vast majority of market participants who hold futures contracts do not have the operational infrastructure to take delivery of physical silver. They are financial traders, not metal handlers. When delivery pressure builds, many of these participants will accept cash settlement at the prevailing spot price, rather than navigating the logistical complexities of taking physical delivery. This financial pragmatism among a portion of the long side is a structural pressure release valve. It reduces the effective delivery demand below what the raw open interest number would suggest. The exchange's margin and position limit tools are also real. The March 2020 commodity market dislocations across multiple asset classes demonstrated that exchanges will act preemptively and aggressively to manage delivery mechanics when they believe systemic stress is building. COMEX has a well-established operational playbook for high-stress delivery periods, and that playbook includes tools that can change the economics of holding large delivery positions overnight. What the reality checks do not change is the arithmetic of the starting position. A 9.2% coverage ratio going into a contract cycle where delivery rates have been accelerating, registered inventory has been declining, spot to futures backwardation is present and widening, and global physical demand for silver from industrial, sovereign, and retail channels is at multi-year highs, is a structural configuration that requires active monitoring regardless of the available relief mechanisms. The relief mechanisms work more effectively when they are deployed early and when the starting conditions are less stressed. As the coverage ratio compresses and delivery rates rise, the margin of error for those relief mechanisms to function smoothly narrows. That is the mathematical reality of the current setup. Let me now translate the 5-signal framework into a practical monitoring structure for the 12-day window leading into the June contract cycle. The first tier of alert is registered inventory crossing below 50 million ounces. This is the threshold at which the coverage math becomes acute enough that delivery demand does not need to be historically extreme to create a mechanics problem. It needs only to be moderately above recent norms. If COMEX warehouse reports, which are published daily after market close, show registered silver declining through the 50 million ounce level, that is the first red flag in this framework. Monitor the daily report. The number is publicly available on the CME Group website under COMEX Silver Warehouse Stocks. The second tier of alert is front-month open interest on the June contract failing to decline at the normal pre-first notice day rate in the 2 weeks between now and May 28th. The baseline for normal roll behavior varies by contract cycle and market conditions, but a rough historical guide is that front-month open interest should be declining meaningfully by the second week before first notice day. If June open interest remains elevated relative to the pace of decline in recent comparable contract cycles, that is a signal that delivery intentions are elevated in the current holder population. The third tier of alert is spot to futures backwardation in the front month widening beyond $1. The current 75-cent reading is notable but not yet at the level that has historically corresponded to acute delivery stress. A widening through the $1 threshold, particularly if it occurs rapidly rather than gradually, is a signal that the physical market is placing a significant premium on immediate delivery over paper claims. The fourth tier of alert is delivery notices on the June contract running at a pace materially above the 8.3% rate seen in the most recent completed cycle. The first week of delivery notices is the highest information period because it reflects the decisions of large commercial and institutional holders who have made deliberate choices to take delivery rather than roll or settle. If the first week of June delivery notices annualizes to a rate above 12%, that is a level at which the registered pool math becomes a genuine operational constraint. The fifth tier of alert, and the one that changes the entire character of the situation, is any COMEX rule change announcement related to delivery mechanics, position limits, margin requirements, or settlement procedures in the silver contract. Watch the CME Group regulatory notices page. If anything appears there related to COMEX Silver between now and the end of June, read it immediately and understand what operational problem it is designed to solve. For physical silver holders, the current environment is fundamentally different from the environment faced by paper contract traders. If you own allocated physical silver held in a vault outside the exchange system, the delivery mechanics of COMEX are informative to you as a price discovery mechanism, but they do not create a direct operational risk for your holdings. Your silver exists physically and is yours. The risk for physical holders in this environment is not that their metal disappears. It is that price discovery in the futures market becomes temporarily dislocated from the physical market in ways that create transactional complexity if you're trying to buy or sell at specific moments. Physical premiums over spot can widen materially during periods of COMEX delivery stress, as buyers who want immediate physical metal compete for a pool that the exchange system is struggling to supply at paper prices. For participants who hold silver through paper instruments, including futures contracts, exchange-traded products backed by allocated metal, and unallocated positions in banking institutions, the COMEX delivery mechanic situation is directly relevant. An exchange-traded product backed by allocated metal in vaults outside the COMEX system has a different risk profile than an unallocated position that depends on an intermediary's ability to source physical metal at the time of redemption. Understanding the specific custody and allocation structure of whatever instrument you use is not optional analysis in the current environment. It is foundational due diligence. The broader market context for this COMEX analysis is not operating in a vacuum. Silver at approximately $85 per ounce on May 13, 2026, reflects a set of fundamentals that were already structurally tight before the COMEX inventory situation developed its current character. The Silver Institute World Silver Survey 2026 projects a global market deficit of 46.3 million ounces for the year, the sixth consecutive annual structural shortfall since 2021, with a cumulative above-ground stock drawdown of 762.1 million ounces since the deficit cycle began. Global mine supply is projected essentially flat at 854.1 million ounces, despite silver averaging $40 per ounce in 2025, which reflects the structural reality that approximately 74% of silver production is a byproduct of base metal mining and does not respond to silver-specific price signals in a timely way. Peru, the world's second-largest silver-producing country accounting for approximately 13.6% of global mine output, issued a formal national energy emergency decree on May 11th, with direct operational impact on its mining and processing infrastructure. The industrial demand side of the ledger continues to absorb silver at rates that have structurally outpaced mine supply for 6 consecutive years, driven by photovoltaic manufacturing, electrical vehicle components, and defense-related electronics. Retail and institutional investment demand is running at elevated levels, with coin and bar demand projected to rise approximately 18% in 2026 to 227 million ounces. The COMEX delivery mechanics situation that we are monitoring is not the primary driver of the silver price in isolation. It is the potential amplifier of a market that is already operating under structural supply pressure. When a market with a multi-year cumulative deficit, declining exchange-registered inventory, and accelerating delivery rates enters a high-stakes contract cycle window, the interaction effects between those variables can produce price behavior that exceeds what any single variable would generate independently. That is the analytical case for monitoring this closely between now and the end of June. I do not get paid by exchange sponsors or financial institutions to tell you everything is fine. I am here to show you the data and the math as it stands. The math currently says that 58.3 million registered ounces against 634 million ounces of open interest, with delivery rates having doubled since January, spot to futures backwardation present at 75 cents and widening, and 12 days until the June contract cycle opens, is a configuration that warrants disciplined daily monitoring. It does not warrant panic, speculation, or decisions made on emotion rather than data. It warrants the same systematic, evidence-based attention that any significant structural condition in a market you are participating in demands. Watch the 5 signals. Monitor the daily COMEX warehouse report. Track the open interest decline rate on the June contract as first notice day approaches. Check the spot to futures spread each session. Follow the CME Group regulatory notices page. And if any of the 5 alert thresholds are crossed, update your analysis before updating your position. The sequence matters. Data first, decision second. That discipline is what separates structured market analysis from reactive noise trading. The June 2026 contract cycle is 12 days away. The registered inventory pool is 58.3 million ounces against 634 million ounces of outstanding claims. The coverage ratio is 9.2%. Delivery rates are at 8.3% and rising. Backwardation is present and directionally widening. Peru has a national energy emergency affecting 13.6% of global mine supply. The Silver Institute has formally documented that the above-ground stock drawdown since 2021 has reached 762 million ounces. Russia has incorporated silver into its sovereign reserve program. The Bank of America published upper bound 2026 price target sits at $309 per ounce. Those are the facts on the table as of May 13th, 2026. Monitor the data, verify the sources, make decisions based on evidence rather than emotion or narrative. The COMEX warehouse report is published daily. The open interest data is public. The spread between spot and futures is visible in real time on any professional data terminal. Everything I have described in this analysis is independently verifiable from primary sources. Pull the data yourself. That verification process is not optional. It is the entire point. Invest with logic, never with noise.